Alrighty, we are ready to get started today. How's everybody doing out there? Hope you are doing well. My name is Andrew Kuhn, sitting alongside Geoff Gannon. Jeff, how's it going today?
I am doing well.
You are doing well.
And how are you doing?
I am doing well.
Good. So they should be too then.
That's three wells. Everyone, I said, hope they're doing well. You said you're doing well. I'm doing well.
Good.
We're all doing well. We want to thank everybody for tuning in. This is a Focus Compounding Podcast. If you want to get access to our investing website where people write about ideas, individuals and professionals from all over the world, which is pretty cool, go to focuscompounding.com and be sure to sign up using the podcast promo code, which is podcast. And that will take $10 off your subscription price indefinitely as long as you stay a member. So today we're going to be talking about value trading.
Which is something off the website.
Website.
Up, yeah.
Shout out to David. I believe that was his name. He wrote an excellent website.
And the article,
Yeah, the article. And it was about value trading. And he sort of related the article to Alan Meekum. And I think because a lot of people have talked about his investing in the past, how his returns, I guess people are attracted to sort of how he does things, and it's public knowledge that a lot of the stocks that he's also owned, I guess more than once probably throughout his career or something like that.
Right. Yeah.
That's sort
so
of
it's percentages and have gone up and down the position size. Yeah.
Yeah. So value trading. What are your thoughts about it?
Right. So this one in the article talks specifically about Berkshire Hathaway and Cimpress. So, which are large positions for him, and as an example there in the article. So what we're defining here is value trading, because there was actually some comments about this in the article, is kind of a difference of what people think about what we mean by trading. So what we're talking about here is that someone could get additional return in a stock because of their timing of their purchases and sales versus something like what I do, which doesn't have any trading element to it. It might be speculative, who knows? But if I buy NACO, I buy it once, and then I don't buy more or sell it down.
Yeah, you just plop it all in at once and then hold it.
So there's basically, as much as the market can take, as long as it's liquid enough for me to do this, I have one entry point and one exit point, and they could be one day. The days could be separated by 3 years, 5 years, but I'm in on one day and out another.
And that's kind of different if you've ever looked at his portfolio. Sometimes he'll own like a percentage of his portfolio in a name or something like that.
Right.
Yeah. And he's a concentrated investor. I think Berkshire is like 20 to 30% of his portfolio.
Yeah, I think each of the two biggest ones are a number very close to that. Yeah.
Yeah. So I know they're big, but why do you think he does that?
That's a good question. I think probably because he only knows a few stocks really well.
Yeah.
And so he cycles through those particular ones. Returning to the same names that way, and probably has a good idea of what he can value that way. And the article isn't just specifically about his investments. Obviously, there's other things in there too. But it's an interesting point because something like Berkshire, sometimes when I talk about the return you'll get in a stock, I can break it down to a hold return and a trading return. The hold return is what will happen if you own the stock indefinitely, and we can do different periods of time. We can say, okay, if you own this for 5 years, 10, 15 years, you'll basically get what the stock itself is growing its value at. Whereas your trading return is going to be the closing of some sort of valuation gap. And the issue that value investors have, we can kind of divide people into value versus quality. Quality investors, they invest in a company that's compounding its intrinsic value 20% a year. They might pay too much for it at first. But if they own it for decades, eventually their return is going to approach 20% a year.
Sure.
Value investors might buy something that's worth $1 for 50 cents. If that value gap closes this year, they make a huge return. But if it closes in 10 years, they make a much lower annual return because the company itself isn't compounding at a good rate.
Sure.
And so it becomes a question of how those two numbers add up together. And obviously it works best if you have something where you buy into a stock, say Berkshire's compounding at 10% a year. Plus, it's cheaper when you buy it than when you sell it. So then you're adding a return on top of that too, right? But if you just did something where it's selling at 2/3 of its value, but that value isn't going up over time, then your return is going to be a lot lower, the longer you hold it as a value investor.
Yeah. And I guess for Berkshire, do you think like a good trade, and I'm quoting trade in here, is when Warren Buffett says that I think once it gets under 1.4 times book or in that area, he'll buy back stock.
Sure.
I think with it currently, I think it's actually at like 1.34 times book value currently today.
Sure, that's one way to think about it. Absolutely, yeah.
Yeah. So
especially if you're like thinking about it relative to the market, Berkshire owns a lot of stocks, so there is the potential that it's a better buy when it's the market is cheap than when the market's expensive, obviously, because the individual stocks are also cheaper in their portfolio.
Do you think it's tougher because then you're timing, I guess, certain situations more?
It could be tougher. So the article talks about basically not selling something to buy, not selling something to hold cash, but selling some of Berkshire to buy more Cimpress, selling, or whatever.
So really
else.
just like cycling it through.
Right.
Yeah.
So you have 5 ideas. One of your ideas gets more expensive than the others. Sell that one and buy more of the cheap one, basically. And I think that works if it's what we just described, not holding cash, but that you have an idea that's cheaper. How can I own more of that? Well, I can sell the thing that's more expensive. But not necessarily selling all the way out of a stock either. You don't have to necessarily do that.
Yeah, and it probably comes down to obviously just knowing the companies in and out, and so I guess if a business gets to a certain point of cheapness because it's getting pummeled by the market, whatever, just destroyed by the market, you're like, okay, you understand it more.
So we could look at some of the stocks that we've talked about on this podcast. We've talked about Frost. We've talked about Omnicom. I've given numbers where I've said here is something I think would be a good time to buy it at. So like with Frost, I've said in terms of what their deposits are, price to the deposits per share versus the share price, right?
Like when it equals each other or what?
So like when we wrote it up for the newsletter, the deposits per share could have been, pretty high. It was not just 3 times. It might have been 4 to 5 times the share price. So say the share price was $50. It was actually less than that, but say it was $50. The deposits per share might have been closer to 200.
Oh, wow.
So that gives you an idea of how, And we gave that calculation for each bank and showed which banks were under about 3 times deposits and things like that. Now, it depends on the bank because in Frost's case, we think each deposit is worth more than it is at other banks because they pay almost nothing for their deposits, whereas some other banks pay a lot. Omnicom is another one I mentioned, price to sales for that one. So we talked about that stock, and I said something like, well, at $65 a share would be a really good stock to buy. But that isn't a fixed price. It's saying calculate the price to sales ratio. When it's close to 1, you should buy the stock. When it's over like 1.5, the stock isn't as attractive. So the time to buy is when it's between like say 1 and 1.5 or something. If it's over 1.5, it may only do as well as the market or something like that. So that's a way that you could think of value trading a stock like that. If you're comfortable with that stock. Now, if you're not comfortable, then you don't buy that one. We talked about eGov. We talked about Tandy. So these are things that if you're comfortable with the business, you could think of as something to buy, but then you also have to think of a price, a multiple, really.
Sure.
Like price to sales or something like that you'd be comfortable with. It can't be a specific stock price. It has to be something that moves.
Relative to the fundamentals.
Yeah,
of the business.
So it has to be something that moves. Like we said, Berkshire with price to book.
Yeah.
That could be moving 10% a year. So that's something that over 10 years is going to change a lot, the price that you're paying in dollar terms.
Why don't you value trade?
Why don't I value trade? There's a few reasons. One is risk. So we've talked a little bit about this, but I see risk maybe a little bit differently than some people do. I don't see risk in terms of the amount of money that I have, the percentage of my portfolio invested in something at a particular time in terms of volatility, which I think is how a lot of people think about it.
Sure.
So if you buy a stock, it's 20% of your portfolio, but it goes up to 50%. They think, so should I sell some because otherwise half my portfolio's movement each day is going to be determined by this stock's movement. But what I think of it as is the chance that I have miscalculated in my analysis of the company. That I thought the company was a monopoly and it's really not. That I thought the company was cheap and it's really not. That I thought management was good, they're not, all those things. So if you buy more as the stock goes down, you're really taking more and more risk on that same initial idea. It's still that one thought, and now you're doubling down on that one idea that you had, basically. And so that's a big reason why I don't do it, to be honest. I've talked about that before. At the same time, I'm also willing to let something keep going up without selling it off.
Is that why you think you're also for equally weighted portfolios instead of...
Yeah, it simplifies things that way, sure. I also think that in most studies that I've seen, for most investors, they're not going to get much out of not equally weighting it. Some will actually be better off by equally weighting. There are some things where I would be better off if I didn't equally weight it, and I didn't. So there's some things where I decided to go bigger into a stock, and it worked out. But it's so rare. I maybe do that once every 3 or 4 years. So, and so I focus more on, in the beginning, figuring out the stock and putting a lot of work into that. And then I don't spend a lot of time monitoring the stock. With this value trading sort of thing, you'd have to spend a lot of time thinking about the positions you already own.
Sure. I mean, well, you think about like NACA, for example. If you bought it where you bought it, and then it runs up to $40 some odd a share, maybe some person would have and this is of course hindsight, right? But sold it off, and then when now it's back down to 30s or wherever. I don't know where it is today.
Well, I mentioned the blog post on Clark Street Value. Mm-hmm. Well, the author of that post mentioned that when it went up to $40-some a share, sold it.
A lot of people sold it.
Yeah, sold it. And some people had the idea of, well, if HBB goes up, I'll sell that and buy more NACO. If NACO goes up, I'll sell NACO and buy more HBB. And, that might work. That stock was obviously very volatile. It went from about $32 to $47 and then back down to $32. So its senses, moved from there. But so you had an opportunity. Obviously, that's a huge change in a matter of weeks.
Do you think value trading has added a lot to Meekum's returns?
Yeah. And that's a larger thing that talked about where his returns might come from. And some people were saying, well,
maybe he uses leverage or something like that.
Right. And I think there is something where he said that he did use leverage. I also, with Berkshire, I think that Berkshire might be a leverage position, but I don't know if that's true. The other thing I mentioned is that he owns one of his top stocks is a heavily shorted stock. And so I don't know if possibly.
Is it Simpress?
Yeah. So I don't know if you would make money off of that if you were lending it out to people. And I don't know if he does lend it out to people, but I mean that's possible, obviously.
Yeah. Do you think if you put together, like an investor should put together a portfolio? I mean, you talk about Omnicom and Frost. Those are companies that obviously pretty thoroughly. And if so much to the point where you say, okay, if Omnicom gets to 1 times price of sales, it's probably a good buy, and then you could sell it when it gets to 1.5 or whatever you said times price of sales. So do you think that individuals listening should sort of build a portfolio of those types of companies, and if they wanted to, that's the way to do it, to value trade?
Yeah, I especially think if you're spending less time than we are looking at stocks. So you won't know as many stocks, and it'll take a longer time for you to know them. I think it's good to only deal in the stocks, buying and selling them, that the companies really well.
Yeah.
The big danger, and Ben Graham said this before, and I've mentioned it, because people are surprised by this when I say this as a value investor, is not paying too much for a stock. That's not the danger. It's owning the wrong company.
Sure.
So if you only own quality companies, because you know them really well, companies that you know well, and that's all you deal in, then the value that you get can be, like we said, from doing this where you buy the cheapest and sell the most expensive. Because the greater danger is that you buy something because it's cheap, but you don't know it that well.
Yeah, sure.
So what you don't want to do is sell Omnicom and buy some other company that's a lot cheaper, but that you don't know as well as that industry or something. Especially if it's, like I said, like that industry, that you're buying into a totally new industry, that's always risky, So if you know that industry well, if you know Omnicom well, then always look for an opportunity, cyclically when it's cheap to buy into it. And then when it is a good point in the economy, sell off some of it. Sure, that makes sense to me. But when we're talking about this value trading, we're talking about a period sometimes of years.
Sure, yeah.
It can vary. Like we talked about with NACO, that could be a matter of weeks that you could sell in.
I was going to say, do you think spinoffs are a good place for value trading because that value gap could close quicker?
It could close
because
quicker,
it's more
sure.
situational? I mean, we talk about... I don't want to say, when we were talking about HBB, you were talking, we have to love the business, okay? But we were also talking about a different situation, which we haven't publicly written about or talked about on the blog. And you said, well, that's more of a situation type of investment is what you said.
Okay.
So maybe in the situation, that's maybe more of you would probably trade that differently than you would trade a business that like Omnicom or like Frost, et cetera. Yeah.
Yeah, so there was a stock they were talking about. I don't know if this is exactly what you're talking about, but... I had said you don't want to own this for a really long time necessarily because it's not going to outperform the market over 15 years or something because of the industry it's in. It's too cyclical an industry.
Yeah.
So buying it for a time and then selling it can be really attractive.
Sure.
But holding it for a really long time becomes a problem because there's a point in the cycle where it earns almost nothing. And that's going to happen because of the business it's in. Everyone will earn almost nothing at one point in the cycle. And so, when you think about it, your really long-term return, we were talking about the stocks. The compound annual growth rate is going to be a geometric return. It's not an arithmetic mean. And people can easily miscalculate that. So, and with cyclical companies, they always do. If you look, people always think that cyclical companies have long-term returns that are as good as non-cyclical companies. And if you look at like the Nifty 50 or something like that, if you find those companies that were actually cyclicals in there, there's not many, but there's a couple that have a cyclical element to them. Over the next 40 years, they didn't return anywhere near what Coca-Cola and Disney and these things that have no cyclicality to them at all did.
Sure.
And so those things are more attractive to trade quickly if it's a very cyclical company because they tend, honestly, a cyclical industry, it's very hard for them ever to earn as good returns as a non-cyclical because if you put the series together, their geometric return is not going to be anywhere near the arithmetic return. And when people think they are doing the average you would calculate in Excel arithmetically, which is not what you're going to get. Just because recently it's been doing 15% a year, there's going to be years in there where it does 2. Sure. And that's going to throw everything off of your calculation. Yeah.
I mean, that's why a lot of people talk about finding predictable businesses when valuing them, right?
Yeah. It makes a really big difference over decades. Now, most people don't own stocks for that long. But even if you're a value investor, having a stock that has that really high return over time, that compounding return, adds an element of safety to your long-term returns, because if you get stuck in it, if the price doesn't rise quickly, the value is still compounding. And you see that a lot. So like, you know, say Omnicom or whatever, if their sales grow a little bit each year and they buy back stock, the price to sales doesn't really have to expand that multiple for you to make enough money to match the market, right? And so that's much better than something that is a, you know, pile of cash that isn't growing. So that's always the issue that value investors have, is how quickly do they realize that value?
Sure. I mean, that's the value gap. Yeah. Interesting. No, and it was a great write-up. And if you have no more thoughts on it, we obviously thank David very much for writing that. It was a great piece, and I definitely enjoyed reading it. Well, we want to thank everybody for listening to us today at the Focus Compounding Podcast. If you do want to get access, and this was sort of an investing, I guess you could say, investing topic type of podcast. If you want to get access to an investing topic memo that Geoff sends out every Sunday morning, go to focuscompounding.com, and on the homepage, you will see a place for you to enter in your email. And then every Sunday morning, you will receive a memo from Geoff on an investing topic. We want to thank everybody for listening to us today. We will see you in the next podcast. Take care.